Hi, thank you, the teams at RBC and Rotman. Thank you for giving us the opportunity to develop our skill towards a field that is quite close to our heart. Let me introduce my team. So we start with David Yakano, a Canadian economist with a passion for hiking and ice hockey. Then we have David Ospino, a Peruvian economist and a food lover. Following on, there is Fernando Ocha, an industrial engineer who is fond of Ironman races. We also include Nikhil Mukhija from India, who was not satisfied with just one MBA and came back for another. And lastly, let me present Vaikit, a Malaysian business administrator with a long passion for digital photography. Thank you. We were assigned the challenge of building a sustainable portfolio that can bring optimal results for an endowment fund with a corpus of $1 billion. Endowment funds' moderate returns expectations allowed us to focus and invest in more sustainable firms to encourage change in industry behavior. Our target is 6.5% before taxes and fees. After researching a significant number of firms, we were able to find a pattern and develop a model to encourage an optimal selection. Our challenges included verifying if the company's announcement had some past track records and their commitments addressed the three key scopes: company, suppliers, and the customer. Another key task was to build a robust financial models for the assets selected. Thank you. After many days of researching, brainstorming, and iterations, we were able to zero in on the two major factors that would decide our model: commitments and actions by the firms. Commitments were further broken down into short term, medium term, and long term, which were further sub-broken down into four ratings: 0, 0.5, 1.0, and 1.5 to improve ratings accuracy and consistency. Actions were broken down into two parts: disclosures and track records, each on a scale of 0 to 6. Thereby, our total score turned out to be 13.5 plus 12, which is 25.5. A cutoff score was close to 70% for the last selected stock.
Levi's is an example of a firm where the strong commitment to sustainability is embedded in its business model and strategy. The Buy Better, Wear Longer campaign advocates for reducing consumption and waste, unlike many fast fashion brands. The company is actively working on its supply chain and looking for suppliers that share its commitment. Levi's has also resisted the generalized adoption of synthetic fibers in its products and is pushing for the adoption of natural and ethically sourced fibers.
Now, I'll explain our financial model to generate the best portfolio for the endowment. First, we use 5 years of data for our stocks. We decided that of the long-term view of the endowment, we will need a risk-free asset associated with that. So we decided to use the 30-year T-view from United States. In terms of expected returns of the market, we relied on BlackRock capital markets assumptions. We use 30 years of expectatives for US capital markets and European capital markets. Finally, we use 5-year betas from public sources like Yahoo Finance or Bloomberg. Considering those assumptions, we ran the expected annual returns for our stocks. For example, we have Autodesk with a 9.4% of expected return and a 27% of historical annualized standard deviation. In other industry, for instance, we included the Canadian National Railway Company with a 5.4 expected return and an 18% of standard deviation. As you can see from the table, we included companies in a diverse spectrum of industries, like Microsoft from technology, Estee Lauder from personal care, and Verizon in communications. Now, our results. By maximizing the Sharpe ratio of the portfolio, we arrived to the next asset weights. To provide these weights according to the endowment criteria, we use another assumptions like no short positions at all, no less than 2.5% or more than 15% in each stock to avoid exposure. And we are including a small part invested in the risk-free asset. So, with all the assets, assumptions, and additional consideration, we arrive to a general expected return of 6.52%, which is completely aligned with the university requirements. In addition, we get an standard deviation of 12.3, which we consider as acceptable given the endowment low risk needs.
We have planned to keep track of the performance of each individual asset as well as the overall portfolio. The portfolio will be managed actively in case the performance of any particular asset is not consistent with the endowment goals. Rate hikes and inflation will be monitored so that the projected cash flow needs meet CU's needs. The performance of any asset depends on the degree to which climate goals are met on a global scale. A smooth transition into a carbon-free global economy will carry higher returns. However, a transition that is not made in an organized manner will put those returns at stake. The worst case scenario would be a world where the 2 degrees temperature increase limit is not met. This will carry lower returns and economic stagnation on top of an environmental, social, and geopolitical crisis. By including companies with a high ESG score, we believe that the effect of climate change risk is countered on our future cash flows. ESG scores for all assets will be tracked and compared on a year-to-year basis. These scores should remain available and come from the same sources and organizations we originally sourced them. Companies that fail to maintain their scores will be replaced and the portfolio will need to be recalibrated. Investing in individual stocks gives our asset management team a more accurate picture of the portfolio and provide them with greater flexibility than just passively investing in exchange traded funds and mutual funds.
Once again, thank you for giving us an opportunity and we look forward to hearing from you. Have a nice day.